think private equity is really fortunate in that regard as far as COVID is concerned, because it's really been seamless for the most part in terms of being able to work remotely. Naturally, there are things that are lost in the process in terms of the day-to-day human interaction. But, for us during COVID, we had our busiest year ever in terms of new platforms and exits and add-on acquisitions last year.
Hello, welcome to Trust Vista Talk. This is Abhilash Jaikumar, co-founder and managing director of Trust Vista. Today's guest is Jeffrey Stevenson, managing partner of VSS. Jeff has been the managing partner of VSS for nearly 30 years and has overall responsibility for the management of the firm in each of its funds. Mr. Stevenson has been the senior member of the investment committee of all of VSS buyout funds and structured capital funds. He joined the firm in 1982, shortly after its formation, and has been the head of its private equity business since its first investment. Previously, Jeff was the executive vice president in charge of corporate finance at VSS, a department he founded. And Mr. Stevenson currently serves as a member of the board of over a dozen companies and has previously been on the board of dozens of other companies. In addition, Jeff serves on the board or is involved with the following organizations: YPO, the SBIA Board of Governors, and the Lincoln Center Leadership Committee. Jeff, thank you so much for joining us today.
Great, thanks for having me.
To start off with, I mentioned you've been with VSS since 1982. We're getting close to 40 years with one organization, which is unheard of, let alone private equity firms. The average age of a private equity firm these days is probably in the single digits with how many new funds are being raised. Can you tell us your origin story?
Sure.
I got into and walked straight into VSS.
Yeah. So
and imagine at that time it wasn't VSS, since you're one of the S's.
Correct. So yeah, it's a little bit of an unusual story. 40 years is a really, really long time. I basically joined out of college. So the two founders of the firm, or the predecessor firm, John Vronis and John Suhler, started a boutique investment bank that was specializing in media. Media was their background, publishing in particular. And the idea was that they would do M&A transactions, bringing a operator's perspective to the transaction. And I joined about 6 months after they started the firm, and ended up doing a lot of the financings for mostly entrepreneurial companies that were looking to raise debt and equity in connection with building up their businesses. And then we ultimately raised our first fund in 1987, and focused also on media back then. And I think that the relevance of the background of the firm, particularly in terms of the operating backgrounds of the two Johns, was that that's really been a philosophy that has continued on. So when we make our investments, we're really thinking about those investments from an operational point of view, not just from a financial point of view. And that's really imbued all of our interactions with the management teams, our board role, how we look at businesses, and how we add value to these companies, because most of the companies we're investing in are lower middle market businesses that are taking on capital typically to accelerate their growth through acquisition. And they're really scaling up rapidly. And so having the benefit of the experience where we have dealt with it beforehand, not just financially, but also operationally, has been part of the added value.
I actually was a media private equity investor once upon a time as well, at a fund called Alta, which was a spin out of Brigg and Deliage, which
remember them well.
Right. And if I think about the evolution of private equity, it started maybe in the late 60s, 70s with a lot of big buyouts, right? It was bankers. It was an industry driven by bankers who had Rolodex, who could, do financial engineering. And then you started creeping into what is now called the middle market, right? Companies where it wasn't just about financial engineering, but, getting to that next level. And that next level was first industry focused, right? The idea of being an industry focused fund was a new concept at some point. And then that further evolved into being operationally focused, actually adding value to the portfolio company. So you were both an industry focused fund and an operationally focused fund. How differentiated were you when you first started this back in the 80s?
I mean, that's always been our orientation, again, because of the backgrounds of the individuals involved.
And maybe I should add, when I say differentiated, when you talk to management teams, today private equity firms are calling management teams very early in their own life cycles. So they always ask, what can you do for us? And it's kind of understood that private equity has to add value. Was that something that was understood by entrepreneurs, like how an investor was going to help them? Or was that something you had to educate folks on?
I would say that that's become, more part of the playbook these days, but wasn't necessarily back then. But it's always been a differentiator to a certain extent. I mean, back when we started our first fund in 1987, there were relatively few. You could count them on, one hand. Media-focused funds. And in fact, industry specialization was fairly rare. And I remember when we raised our first fund for that 1987 fund, investors were much more used to general interest funds. And some of the comments that came back from investors was, we're not trying to pick industries. We're counting on the GPs to do that. So the psychology of the whole thing was almost the opposite of what it is today. Now investors see industry expertise as almost a must-have for the funds that they invest in.
Yeah, you did another thing that was quite novel is you might have been one of the first PE firms to produce content marketing, whether that was a term for it or not. You guys had this communication industry forecast. And it was actually the first time I'd ever heard of Verona Suler Stevenson was your, annual, state of the industry communications forecast, where you forecasted revenue growth over a number of years for each subsector of media. Can you tell me a little bit about what thought process went into producing that? And you produced that for nearly 30 years.
Yeah, well, you're digging deep into our past, but it was interesting because it was an outgrowth really of our M&A activities, and it served. And what we put together a pretty thick document that was, I don't know, 300 pages, and we sent it out every year, and it took all of the available information on media companies, and not just financial information but operational information, and it really became the Bible that even public companies, the largest media publicly traded companies, use to benchmark their own performance. But for us, the key to it was the branding. And so I can remember actually sitting in a conference room in Kuwait City talking to an investor back then, and there was our communications industry report sitting on the shelf. So I mean, this was sent to media companies and investors worldwide. And I think it was one of the most important things that we did in those early years to brand the firm.
Yeah, and I imagine it was also helpful in pivoting away from media as you're making these forecasts, and at some point you start seeing, hey, the forecast for traditional print media or yellow pages or broadcast isn't so rosy. You probably were thinking, how do we pivot? Can you tell me a little bit about when traditional media started getting threatened by new media, new industries that are tangential to what people might have thought of with media? How did you guys think about transitioning your firm after spending decades building a brand in a space?
We often get the question of how did you go from media to healthcare and education and business services? That's not something that is intuitive necessarily, but actually it was actually quite logical from our standpoint. And the reason was that if you look back to that time frame, media companies were transitioning and diversifying into information businesses. Because if you think about media, particularly business to business media, it's content, it's information that's being conveyed to a particular target market. And so the next step then was to buy business information companies. And so you saw some of the larger, not necessarily the pure consumer media companies, but some of the larger media companies that were in B2B, like Reed Elsevier back then, and acquiring LexisNexis and so forth, were getting into business information. And so that was really the first step, was media companies buying information companies, and information companies not being advertising driven, but being subscription driven. So they were diversifying their overall revenue base. So the added value information and the subscription orientation, and then the high renewal rates associated with that subscription business was really the first step. And a lot of that occurred in financial and business information, and then then eventually in healthcare. And so what we were really doing was we were following the strategic path of the larger media companies as they were diversifying their own portfolios into non-advertising and non-consumer segments of the overall information, media, entertainment marketplace. So as those information businesses were acquired, and we started to doing them as well, they became verticalized. So it wasn't information generically, it was information for a particular market. It was information for the financial markets, it was information for healthcare, it was information for marketing. And so increasingly that information became verticalized, and that information was consumed by businesses and institutions through a subscription model.
There's a phrase called alternative data, which is very popular in the hedge fund world, which is data that they would use for a diligence process that's not directly from the company they're evaluating. So not financial information or customer information, but things like satellite imagery or credit card sales data or GPS location data, alternative data. So when we talk about data as a almost type of content or a media business, this is really proliferating quite a lot. What are the sectors for data do you see as being dominant in the years to come?
Yeah, I mean, I think that data. I mean, I think it's all sectors is really the answer. I mean, I think data becomes the key driver. People are very dependent and get an edge from the metrics in the business. I don't think there's any sector that's that can, certainly from an investment point of view. Maybe one of the sectors that is that's still got a lot of potential and is not as far along as in healthcare, measuring outcomes, for example. And I'd say secondly, the education sector, and measuring efficacy in terms of the educational content. So those are actually areas that we find particularly interesting, because while there are certainly large companies that are providing that kind of information, the lower end of the marketplace is populated with lots and lots of niche-oriented data providers, and that's essentially what we're doing, is that we're buying these smaller businesses and we're combining them with other like-kind assets and building them into larger entities. So part of our thesis in terms of what we invest in is centered around those fragmented marketplaces, and we see literally thousands of opportunities of data providers in healthcare and education as an example.
Yeah, you said every sector can benefit from being data driven, and there's a statement I've heard a lot is every company is a data company that does something else as a day job, right? And when you talk about adding value operation of portfolio companies, a lot of times where I'm seeing operating partners get involved is in being kind of an outsourced chief data officer, helping a company organize its own data, first to just manage its own business better, and then secondarily possibly figuring out how to monetize that data. So going back to your DNA of being operating partners of a sort, how has data played into that equation and how you add value to portfolio companies?
Well, I think that there are two things that you're touching on there. One is data to manage the business, and then there's data that comes out of the business operationally. And I think data to manage the business in terms of metrics and dashboards and so forth, have become, absolutely necessary to compete. However, if you're a small business, which again is our focus area, and you're in an entrepreneurial stage and you're focused on, meeting the next payroll and generating the next dollar of revenue, you don't always have the luxury of spending time having the perfect dashboard. So I think a lot of what we're focused on in terms of what I think of investing in these companies at a certain inflection point is we're buying into high growth businesses that are in attractive markets that are looking to accelerate that growth. And to do so, they've got to build themselves out as a platform. And part of that is having better ways to measure that growth. So part of what we're doing with these businesses is actually putting in dashboards and metrics, and we're not doing necessarily ourselves, but it's a collaborative effort with management just to focus on developing those metrics by which they can manage the business better, and also keep track of their growing scale. So that's important. And then, as far as the second part, data that comes out of the business and monetizing that's much harder. And I'd say that it's difficult to do that because generally companies are good at doing what they're doing. And if you're actually talking about a different product or dimension of the business, it's harder to do that and to actually figure out a way of monetizing that data. So I think that's part of what we're looking for. Management teams have got that kind of scope and capability to be able to, to generate those incremental revenue streams out of their business.
Yeah, we have our data intelligence group, which primarily works with the portfolio companies. And you mentioned working with the management teams. It really is important that the management team buys into any transformations. Otherwise, it never goes anywhere. So we spend a lot of time just educating folks on what the power of dashboards and data analytics could mean for their business. But usually once they see a little bit of it, they get addicted to it and really embrace it. Where is the balance between making data-driven decisions and experience, right? You've been in this industry for 40 years. There's more and more data, but it's not necessarily the case that private equity guys are making better investments on average. So how do you balance that expertise and the subjectivity that comes with experience with this whole new world of volumes and volumes of data?
Well, I think I think at the end of the day, you can have, from a management point of view, you can have too much data and you can be swimming in the data. So I think you really want to focus on the key drivers. We have some companies that are really just fantastic at generating dashboards and are really facile at using that data. It needs to be habitual for it to really be useful and productive. So I think, again, focusing on a limited number of, data points that really truly drive revenue and margins, and teasing those out so you know what to focus on, and then making it a habit.
Yeah. And thinking about the business of private equity, the business you've been in for, nearly 40 years, obviously the industry has evolved. We touched upon that, but your own business has evolved over the years, switching from industries. But how has the way you approach managing a private equity business evolved over the last 10 years?
Wow, lots of different ways. It really starts with deal origination. One thing that's changed over that many year period is the intermediary marketplace. It's become incredibly fragmented. So we probably track through Salesforce 400 plus specialized intermediaries. So these are intermediaries that actually have transacted in one or more of our industry sectors. And one of the great things about data and how we manage that differently today is that we actually know what transactions they've done. We know who the counterparties are, and we have a lot of information on those particular intermediaries. So we essentially know all of the intermediaries who are doing any deals, of which there are many thousands of deals in our particular marketplaces. So that's number one. Number two is that we have a whole dedicated business development effort, which we didn't used to many years ago. And their sole purpose is to call on those intermediaries, making sure that they know of us, what we do, how we're differentiated, and make sure we're in front of them. So you're really, managing a pretty big universe of sources of that deal flow. And then constantly following up, developing relationships with them. Conferences, industry conferences are really important, and so we have a whole effort around attending conferences, generating the attendee lists, and setting up meetings with target companies. And then, I'd say thirdly, we're probably more thematic today than we were, back in the early days. Back, when we started off in media, you could count, essentially on one hand the things we focused on. It was radio, it was TV, it was magazines, it was newspapers, cable television, and that's where the list ended. Now the sectors and subsectors, are in the dozens. Just healthcare by itself has got so many facets to it, and different tributaries that we can pursue. But there are themes that go across those. So I'd say it's more complex. But anyhow, so I'd say deal flow and deal origination is one thing that's changed a lot. I think that the second thing that's important is in the area of due diligence, and particularly how technology impacts these businesses. It's much different than when we were investing in just media, and all radio stations were more or less the same, different music formats, different markets, but the essential model, the business model, was the same from station to station or magazine to magazine. Now with the how technology impacts these companies, it's a whole nother level of due diligence. And of course, there's a lot of competition. So, the due diligence effort is more nuanced, more intensive. So I think that's probably number two. It's a much more competitive environment than when we got started. More deals are in a process, so it's much more competitive. You really have to have an angle and a strategy and a way of adding value over the course of time, because multiples are higher now than they were back then. We tend not to use as much leverage as a typical private equity fund, so our returns are generated more by the increase in the EBITDA and the add-on strategy than purely paying down debt, although that's obviously part of it, but not to the same extent. And then the third area would be in managing the business itself and working with the management team and adding value in that regard. And that really falls into a few categories. We talked about dashboards and things of that nature, and we find that there's typically room for improvement in terms of the sales function and the sales process. So we're focused on that area. We can be helpful to these companies in terms of generating add-on acquisitions and ideas, and because we've invested in about 100 different portfolio companies that have done over 400 add-on acquisitions. It's a playbook that we've used many times, and so we can bring that added value. So it's really, so there's so many different ways it's changed over the years. Those are just.
But what it sounds like, so you have to do more work on origination, more work on execution, more work to add value. But the check sizes and the 2 and 20 haven't really changed. So how do you do it?
How do we do the more work?
More than you, as an industry and as a business, how are you doing more in each of these facets, right, with the same economics and being able to do it efficiently?
Well, I mean, I think it just kind of goes with the territory. I mean, generally speaking, fund sizes are larger. Our fund sizes are larger than when we started, so we can afford to have a bigger team. It's critical to have the right team that can kind of dig in on all of this stuff. So you adapt and you figure out a way of being efficient. But to me, the part that I enjoy the most is dealing with the entrepreneurs and working with them in terms of their objective of building a bigger business and a more important business. And, I think that that's the same today as it was when we got started.
When I talk about this idea of the business of private equity, it wasn't thought of that way, 15 years ago, let alone 30 years ago, that a private equity firm itself is a business that could add value. And recently we've seen a lot of, GP stakes funds being raised, Dial Capital going public, right? Bringing light to that, hey, an asset management business is a business that has value. And structurally, what else has changed is this idea of adding value to the operating company. It takes time. It sometimes takes more time than it used to. So how have the innovations in private equity as it relates to stretching J curves and thinking about the business of private equity, shaped how you are running VSS?
I think the big difference in how these businesses are operated today, of course, the scale is much greater, and in some cases, really significant scale. We're very much lower middle market, so we're still, in the scheme of things, a small business. But, the big thing that's changed over the years is the compartmentalization of functions. So it used to be the case that when we got started, and really all the private equity funds I knew back then, is that everybody did everything. The deal sourcing, deal execution, fundraising, and everything in between. And I'd say that the difference now is that, a firm of our size and greater, the functions within the firm, if you break it down, such as I was discussing beforehand, origination, tends to be a department, and it's a group of people who are just doing business development and just calling on intermediaries and companies on a direct basis, which isn't to say that the other people on the deal team aren't generating deal flow as well, but I'd say that 80% of it is now developed by that dedicated group of people. The same thing is true of fundraising. So while I'm, as the managing partner, still fundraising, we now have a fundraising team and people who are dedicated exclusively to investor relations, developing new relationships, maintaining existing relationships, having more regular dialogue with our investors so that they're knowledgeable about what we're doing. So I think that compartmentalization of functions is one of the things that from a private equity as a business standpoint, I've seen change.
Yeah, and I think that lends itself towards the institutionalization of the industry. And I think a lot of new managers who are just launching a PE firm for the first time don't often appreciate the amount of capital it takes to build a real business, right? They can look at the companies they invest in and make a plan, and often they don't drink their own medicine, as it were, as to the best practice of building a business. And you mentioned in the portfolio companies, often the fat part of the bat is sales, where you can improve. So similarly, business development and IR are effectively the sales functions of a private equity firm. And certainly seen a lot more people built an entire career in private equity at this point, only being on the origination side. And that's certainly a clear career path. Given the last 18 months we've had with the pandemic, working remotely, how do you think this shakes up the private equity industry and how it functions and operates going forward?
I think private equity is really fortunate in that regard as far as COVID is concerned, because it's really been seamless for the most part in terms of being able to work remotely. Naturally, there are things that are lost in the process in terms of the day-to-day human interaction, but for us during COVID, we had our busiest year ever in terms of new platforms and exits and add-on acquisitions last year. So we didn't really miss a beat, and that was done where people were for the most part remote. I think one of the things that's changed that is a good thing is that there's more of the vetting process for a new deal that's done by Zoom, as opposed to hopping on a plane and chasing out to Dallas to have a management meeting and presentation for a company you don't even know if you are interested in yet. That sort of tended to be the case, and I'm sure will be the case again. But it's now more the case that you'll have a Zoom call, you'll make a determination as to whether or not that company is interesting, whether or not it's something you really want to go after, and then there's more ability to do data room access virtually, and so when you actually ultimately you have to meet management. And some I've heard some have done deals and closed deals without actually physically meeting management. I think that's probably not the case for most, and certainly not the case for us. At some point you have to meet the people. But it's much more efficient to do that after you've decided that it's really something that you're truly interested in. The other thing that I think has become much more efficient is the fundraising process. We went through a fundraising over the course of the past year, and didn't get on a plane. And we have many new investors and obviously existing investors that re-upped that we did not meet in person. And I think that the fundraising process has been, become increasingly inefficient over the years, because you get on a plane and you go some distance and you discuss your fund, and the investor may or may not be interested, and that's and they want to meet with the more senior people in the firm. That's very time consuming. So much better to do this type of thing, by Zoom, and then ultimately develop a relationship. I think on the negative side, there's the in-person interaction that you can't substitute for by Zoom. So I think particularly the the middle level of the firm, the associates and directors and VPs, there's a huge benefit of being able to to get together in person and share opinions and information on deals and so forth. And yes, to a certain extent that can be done by Zoom, but having the human interaction just from a collegial point of view is critically important. So going forward, it'll probably be more of a hybrid model, I suspect, where it doesn't go back to the way it was beforehand, but doesn't stay the way it is.
Yeah, I was going to ask you about that. How do you see the work function within an office? Because it's historically been almost an apprenticeship model where junior people work closely with the partners and over years develop that expertise. We've seen as a corollary to this and how private equity has boomed, our businesses nearly doubled in the last 2 years, as well as there's just been so much more increased demand for support at the junior level. But increasingly, if your associate is not in the office with you, doesn't matter if they're 20 miles away or 2,000 miles away. But we do see people have reimagined what it means to have their own junior people. How do you have them engaged more with being outward facing rather than being inward facing? When you do have those days where you're in the office together, how do you spend it productively interacting, not saying, okay, we're going to be in the office for 3 days and the days you're here, you're going to be sitting in front of Excel the whole day?
Yeah, no, I think actually, I think it's a really interesting and positive development, because it's good to get out of the office, but on the other hand, it's really difficult to Zoom all day long. What I like about the remote part of it is that for us as a smaller firm, it allows us to bring on people who are not necessarily going to be based in New York City. So we've hired an associate recently. He's based in Boston. Yes, he'll come, and to, be in the office here, now and again, but it doesn't have to be. We had a management presentation yesterday that we went up to that was, in the Boston area, and I went up from New York and he came down from Boston, and, it all worked fine. And then, again, as a smaller firm, we don't have offices all over the country, but you could easily imagine that we could have somebody in LA or Dallas or Chicago or, all of the above that is working full time for us, but they're working remotely. So I think that it's net a pretty big positive.
And how has the pandemic been for your portfolio, given the industries that you're investing in?
Yeah, so it's been fine. It's hard to totally generalize because it's definitely case specific. Some of our healthcare service companies, for example, we have a company that's in the dental subspecialty of endodontics, and for the most part, other than the really essential healthcare services, most of them had a pretty tough last April of 2020, that is. But they all bounced back, shortly, thereafter. So there was an impact. Another company that we had that was impacted does payroll services for the entertainment industry. So, TV and film production, and there wasn't much new production being done last year. So no new productions, no payroll to process. So that took a hit for a while. But really, in all cases, they've bounced back to levels higher than their pre-COVID levels. So healthcare services were way above. That payroll service company, was interesting about that is that we won a lot of new business, particularly in the animation area where you could work remotely, and people were doing new productions by doing it on their computers remotely. Now that productions are starting up again, our business is booming. One of the interesting new deals that we did during COVID is in the education business, and they provide educational content via software to the K-3 marketplace. And pre-COVID, because we were looking at the business pre-COVID, the thing that we thought was unusual, or one thing we thought was unusual, and weren't so sure what we thought about it, was that they were a 100% virtual company. They had no offices. There was no corporate office. There was no any office. And so that was a bit of a head scratcher back then. Quite frankly, we had that on our con list of considerations. And so COVID hits, all of a sudden it goes to the pro side of the ledger, it's will be triple the EBITDA this year. And the part that was the most interesting during our evaluation of the business during COVID was sales. Because most of their sales were done in person. So somebody from the company would go and have a in-person conference with a group of teachers, showcasing the software, explaining it to them. Basically that was the sales process. So needless to say, during COVID, that wasn't happening. So they converted that to, this type of format, a Zoom call, and we weren't quite sure how that would work out, so we slow played the due diligence, and ultimately they sold so much more by doing it that way. And you think it sort of intuitively makes sense because their reach overnight became so much greater than what they could actually physically do by meeting with people in person. That too will probably go back to somewhat of a hybrid model, I would guess, but there are aspects of companies' business models that were forced to change. But I was surprised. We have 19 companies in the portfolio right now, and thousands, 3,000 employees across those companies. I was really impressed with how quickly those companies and those management teams were able to make the adjustment to a remote working environment. And so that was impressive in terms of how they did that. But also, if you think about it, if this happened 5 years ago, or for sure 10 years ago, none of that would have been possible.
Technology has changed the way we can do business, and the pandemic has forced us to change it despite our resistance to it. The other aspect of what's going on in the market right now, I hear from a lot of private equity firms, is valuations. Right? They seems to be a seller market. Valuations are higher than they have been. And some PE firms take the approach, hey, we're not in the business of timing the market. If this is what valuations are, then this is how we deploy capital. Whereas other firms say, our LPs want us to be judicious and sit on the sidelines or be very picky. How do you think about the current market valuations and how you approach the investment opportunities you're seeing?
Valuations are really high. We see 500 deals on average in a year. We're bidding on maybe 10% of them, and it's always shocking every Monday morning when we go through our list of companies that we've submitted a bid on, how far off we were and how much we lost by. Actually, I'd rather lose by a lot than just by a tiny amount. But there's no question that valuations are elevated at the moment, and so I don't think we've fundamentally changed our approach in that regard. Maybe our multiples have crept up somewhat, but not commensurate with the market. What we've done is that we've really moved down market, smaller companies where the multiples, while still higher relatively speaking, are not as high, and we put much more of an emphasis on the add-on part of the strategy. So there's still a huge arbitrage between the small end and the large end of the marketplace. So we can capture that multiple arbitrage and have the buy-in multiple be lower. So for example, we bought into a endodontic platform that just had 6 practices. We'll probably have, this is 2 years ago, we'll probably have right now 75 over the past 2 years. And we've just been buying up small practices, aggregating that into our platform, building out the platform. And, now it's a, reasonably sized business that's got, well more than 10 times the EBITDA where we started 2 years ago. So in that marketplace of healthcare services and physician practices, once you get to that level of EBITDA, the multiples are well into the double digits, 15 to 20 times. But that's not where we started. We started with a single digit multiple because we started with a much, much smaller business.
Maybe we can go in a different direction for a second. What keeps you busy outside of VSS?
Well, I'd like to say I've got a decent golf game, but that would be stretching it a bit. A few different things. My wife and I are involved with a nonprofit, 2 nonprofits actually. One called Fraxa Research Foundation, which does brain research in an area of autism called Fragile X, which is a specific gene disorder. So we've been involved with that for over 20 years and funding a lot of basic research around the mechanisms within the brain that are impacted by this particular gene disorder. So that's one thing. We're also involved with a similar kind of entity called it's the Center for Discovery, which is more of a school and a residential community for kids with autism and physical disabilities. It's located near Monticello, New York, in a town called Hurleyville. So we're very involved with that. So those are sort of the, I say the key in terms of our philanthropic activities and involvement. We've got 4 kids.
Just led with 4 kids, that's plenty to keep you busy outside of VSS. But it's amazing work you're doing, on the philanthropy side. And my wife is a social worker and had worked with children in public school districts that were troubled. And this past 18 months has been especially difficult for that community. Can you maybe shine some light just for our audience on, how the pandemic has disproportionately impacted people with special needs and what people might be able to do to contribute and help?
Well, the big thing has to do with with getting the shots, and the impact of that, because the more severely affected kids don't understand what's going on with this pandemic. They don't understand why they have to wear masks. They don't understand why they have to be isolated. And so it's been really difficult. And then if you think about the healthcare workers, I mean, these kids are more medically fragile than most. And so if they were to get COVID, the mortality rate is much, much worse. So these places like the Center for Discovery really, and they do an amazing job, have got the level of caution and safety is at a whole nother level that that most of us just don't even comprehend. So I think that's been a huge challenge.
Thank you for the work you're doing there. It's very much appreciated and respected. Well, Jeff, it's been such a pleasure speaking with you. Thank you so much for sharing your insights and your time. And I look forward to speaking to you again soon.
Great. Yeah. Thank you. Enjoyed it, and hope to talk soon. Thanks.